Why is one US dollar worth less than 1 euro, but worth more than 170 Japanese yen? It's the exact same dollar. So why does its value change the moment you compare it to another currency? The answer has nothing to do with the paper itself. It has everything to do with the economy behind it. A currency isn't valuable simply because a government prints it. It's valuable because millions of people choose to use it, save it, accept it, and invest in it every single day. So the real question isn't, why do currencies have different values? It's what makes millions of people around the world trust one currency more than another. Once you understand that, exchange rates stop looking like random numbers. They become a reflection of how the world values one economy compared to another. And to understand why, we need to go back to a time when money worked very differently. For centuries, money was tied to something people already trusted. Gold. Every dollar, every pound, every franc represented a fixed amount of it. This was known as the gold standard. The idea was simple. If a government wanted to create more money, it first needed more gold. No gold, no new money. That kept currencies relatively stable because governments couldn't create money whenever they wanted. But the world didn't stand still. Economies grew, trade expanded, wars became more expensive. Financial crises demanded faster responses. Gold simply couldn't keep up. So one country after another abandoned the gold standard. And from that moment on, money was no longer backed by gold. It was backed by something far less tangible: trust. Today, almost every country uses what economists call fiat money. The name sounds complicated. The idea isn't. Modern money has value because people continue to accept it. When you walk into a supermarket, you don't stop to ask whether the cashier will accept your money. You already know they will, and the cashier knows someone else will accept it too. That's how modern money works. Its value comes from the confidence that someone else will accept it tomorrow. But here's the important part. Trust gives a currency value. Supply and demand decide how much that value is. If trust were the only thing that mattered, every currency would be worth exactly the same. Clearly, they aren't. Some become stronger, others become weaker. And the reason is surprisingly simple: supply and demand. The first factor is inflation. When a currency keeps losing purchasing power, people become less willing to hold it. The reason is simple. Imagine you have two choices. You can keep your savings in currency A or currency B. In one country, prices rise slowly. In the other, prices rise so fast that your money buys less every month. Which currency would you rather keep? Probably the one that holds its value. Now imagine millions of people reaching the same conclusion. Demand for the stronger currency increases, while demand for the weaker one falls. And when demand falls, so does the currency's value. That's why countries with high inflation often have weaker currencies. Zimbabwe is one of the clearest examples. Years of excessive money printing, economic mismanagement, and hyperinflation destroyed confidence in the Zimbabwean dollar. Eventually, many people preferred holding US dollars instead, not because the paper was different, but because they trusted it to hold its value. Confidence takes years to build, but it can disappear much faster. So, if high inflation pushes investors away, what brings them back? One of the biggest factors is interest rates. Here's why. Imagine you have $100,000 to invest. You could leave it in country A or move it to country B. Country A pays 2% interest. Country B pays 5%. Assuming both economies are equally stable, which one would you choose? Most people would pick country B, and that's exactly what investors do. But before they can earn that higher return, they first need to buy country B's currency. That simple decision creates demand for the currency. Now imagine millions of investors doing the same thing. Demand for that currency increases. And when demand increases, its value usually rises as well. Of course, higher interest rates aren't a free lunch. Borrowing money becomes more expensive. Families think twice before buying a home. Businesses delay expansion. The economy begins to slow. That's why central banks are constantly walking a tightrope. Raise rates too little, and inflation can spiral out of control. Raise them too much, and the economy may struggle to grow. Finding that balance is one of the hardest jobs any central bank faces. Interest rates aren't the whole story. Imagine you're about to invest billions of dollars in another country. Would you only look at the return? Probably not. You'd also ask a much more important question. Will my money be safe? Can businesses operate without constant political uncertainty? Will the rules still be the same 5 years from now? Or will they change overnight? For investors, stability has value. Countries with stable governments, predictable laws, and healthy economies tend to attract far more foreign investment. China is a good example. When it opened its economy to foreign investment in the late 1970s, companies rushed to build factories there, but they couldn't pay workers, buy land, or build those factories with dollars or euros. They needed Chinese yuan. And when thousands of companies all needed the same currency, demand for it naturally increased. The same principle applies everywhere. People don't buy a currency because they want the currency. They buy it because they want access to the economy behind it. Foreign investment isn't the only reason a currency gains value. Trade plays a huge role too. Here's why. Imagine a company in Canada wants to buy a car from Japan. The Japanese company doesn't want Canadian dollars, it wants Japanese yen. So before the payment can even happen, the Canadian buyer first needs to exchange Canadian dollars for yen. Now imagine that happening millions of times every single year. Cars, electronics, machinery, food. Every time someone buys a Japanese product, they create demand for the Japanese yen. And when demand for a currency increases, its value usually rises too. The same principle helps explain why the US dollar became the world's dominant currency. For decades, most international oil has been bought and sold in US dollars. So whether a country was buying oil from Saudi Arabia or somewhere else, it usually needed US dollars first, not because dollars were the only currency that existed, but because they were the currency the global market relied on. The more people need a currency, the more valuable that currency tends to become. And sometimes, simply being the currency everyone needs is one of the biggest advantages a country can have. Of course, not every country lets its currency move freely. Some choose a different approach. Instead of letting the market decide its value, they link their currency to a stronger one. This is known as a pegged exchange rate. Think of it like a small boat tied to a much larger ship. As long as the larger ship stays on course, the smaller one follows. That's exactly how a currency peg works. For example, Brunei has linked its currency to the Singapore dollar for decades. That gives businesses something they value enormously: predictability. Companies can make long-term plans without worrying about sudden swings, but stability always comes with a price. When your currency is tied to someone else's, part of your economic freedom goes with it. If the stronger currency rises, yours rises too. If it weakens, yours follows. You gain stability, but you give up flexibility. And for some countries, that's a trade-off worth making. At this point, you might be wondering, if one shared currency makes trade so much easier, why doesn't the whole world use one? It sounds like the perfect solution. No exchange rates, no currency conversions, no wondering how much your money will be worth when you land in another country. In fact, Europe already gives us a glimpse of what that looks like. The euro allows millions of people to travel, trade, and do business using the same currency. It's convenient, but convenience comes at a cost. Every economy is different. Some countries are booming, others are struggling. Some need higher interest rates, others need lower ones. When countries share the same currency, they also share the same monetary policy. That means they can't always make the decisions that are best for their own economy. The European debt crisis showed just how complicated that can become. One country's problems can quickly become everyone else's. So while a shared currency removes many barriers, it also means sharing many of the risks. And that's why, despite all the advantages, most countries still choose to keep control of their own money. So what really gives a currency its value? It's not the paper, it's not the ink, and it isn't the number printed on it. A currency reflects the economy behind it. When people trust that economy, they're willing to save its currency, invest in it, trade with it, and hold it for the future. That creates demand, and demand creates value. But when inflation spirals out of control, when investors lose confidence, or when an economy becomes unstable, that demand begins to disappear. And so does the currency's value. That's why the Japanese yen, the euro, the US dollar, and every other currency in the world have different values. Not because they're printed differently, but because the economies behind them are. Exchange rates aren't random numbers. They're a reflection of how the world values one economy compared to another. And once you see them that way, they stop looking complicated. They start telling a story. Every economy tells a story. At Financial Cycles, we're here to help you read it. If you enjoyed this video, subscribe and join us for the next one. Thanks for watching.